right. We are back. Live stream. Back at it. FOMC day. Live stream. Fed cutting rates today. 0.25%. We have a lot to talk about. I think in preparing for this live stream, probably going to be one of the more important streams I do all year long. So if you're catching it live, congrats, good for you. And by all means, if you're in chat, you have questions, fire them away. Last stream was really cool. We had a lot of good questions, so we can certainly divert to engage with some questions. But I am going to want to keep it a little bit on topic out of the gate with regard to the rate cuts. Like I said, we did get the 25 basis point cut, but more importantly, we also saw what the pathway forward is with regards to what the FOMC wants, given the data that we've seen play out over the last couple weeks here. I'm thinking particularly the employment data, which wasn't so great, and I know that has been impacting some of the Fed decisions. So that's what we're going to discuss tonight. Like I said, we got a lot coming here. I have to admit, in the post tariff Liberation Day period, right? Especially when it was very clear, even before Liberation Day, what was going to be happening with regards to the Trump administration and all the major changes they were going to want to put through from a macroeconomic perspective. It's been a little dicey as to how things really play out, but I think ultimately the picture is becoming very, very clear, and I'm a lot less bullish than I was, say, 6 months ago. And I think the implications of everything we're seeing are, it is becoming very clear where I think the next 6 months is going to go, but more importantly, maybe where the next 18 months is going to go. So, I have a lot I want to cover. One of the things I did do, and I'll kind of show you right now where we're at. I put together a little simulation run as well. We're going to dive deep, so buckle up, all that sort of stuff, and we're going to go a lot of theory, get very deep in theory, get very deep into just how to think about everything right now from the 30,000 feet kind of macro perspective. All right, let's see. We do have some chats rolling in real quick. We'll let everyone else kind of come on board here as the stream gets going. Hamel, welcome, man, from Australia. We got Frank coming in. Thank you for joining. Good evening from Lakeland, Florida. What up, Kevin? Thanks for joining. All right. If you're in chat and you do have a question that you feel pressing, maybe give me a half an hour before, by all means, if you need clarification, jump in. But give me a half an hour to kind of go through at least kind of the monologue part here that I want to cover. And then as always, if you put question in your question, it comes up yellow on my screen, so I know to track it. Obviously, super chats will get jumped to the top. Not that they're required. I'm glad to interact with anything, but that is that. So what we got today, again, was that quarter cut. And then it's very clear that now the Fed probably wants another 50 to 75 basis points by the end of the year. You have Stephen Mirren is the outlier saying by the end of the year, we should just slash rates entirely in half. What is ironic as I look at the dot plot here is I'm just like, well, it seems as though the anticipation is for 3 into the future. So why not just permanently set it at 3? I don't know. Anyway, that's neither here nor there for what I want to discuss. But the more that I'm studying and kind of looking at, and I've been kind of laying this groundwork to begin with, and that is that fiscal is not anywhere as strong as it has been in terms of its kind of acceleration function over the last handful of years here, especially after the 2022 slowdown from the tax receipts, and then after that played out in the rate hikes. I mean, it really accelerated fiscal, but that is very, very quickly slowing. In fact, I think what I can do real quick is I'll just actually pull up the monthly Treasury statement chart, the rate of change that I love to follow, and inflation adjusted. You can just see that we're really starting to see that deceleration that I've been saying is happening as you track the daily side of things. You're absolutely seeing that, right? So we're at we'll call it 5.5%, peaking before Liberation Day, and we're now down to under 4.5%, and that deceleration continues to play out. I haven't checked the Trump spending comparison tool. But we are just slightly above, 35 billion above last year, but again, entirely in track with where we are last year. So this is actually, and I'll hover around this point for just a second here, and just to make sure that this point gets driven home. And that is that you need an acceleration of spending, right? So you can't just have, if you have $1 trillion of spending, this is credit or fiscal. If you have $1 trillion of spending in year one, and you have, just say a GDP of 25 trillion or something like that. So you have a trillion of spending of government spending in year one, you have a $25 trillion GDP, and you get that same trillion the next year, GDP will remain, all else being equal. Now I know that's a big qualifier because all else is never equal in a dynamic, complex system. But all else being equal, GDP the following year will be zero, right? So if you went from year zero, let's just say at 24 trillion GDP, and then you increased to 25 trillion GDP, so you had $1 trillion GDP growth, your growth, assuming no new money ever enters the system, will be zero. You'll still be at a GDP, the flow count for that year, of 25 trillion. So growth is zero. And in a world where growth expectations are at, whatever they are, 3% right now, 4%, that's going to be a miss. And the feedback loop that ends up happening is when you're not getting the growth that you were expecting, this being the macro economy, the aggregate producer, your investment's going to slow. And then when your investment slows, that reinforces that downward spiral of lower growth, and you get the exact reverse occurring from what has essentially been the buildup for the last, say, 3 years now. And so that's why it's so important to get the continued add of government spending accelerating. So when you do get the inevitable crunch on the credit side, which will always happen, you always get, there's no way to stop the credit cycle from cycling, is that you have the fiscal there to support, you have the accelerating fiscal there to support the contraction that you're inevitably going to see on the credit side. And my whole point has been that come April, May of next year, we're not going to be accelerating on the fiscal side. And I think it could even be worse than just not accelerating. I mean, really, we get to a deceleration standpoint. The more I understand exactly what the One Big Beautiful Bill is, the less I'm convinced that it's going to be gangbusters in terms of spending. One of the themes that's going to come up quite a lot in the stream today is I have been communicating just back and forth with Michael Green, the passive investing. His big thing is passive investing, but one of the things that I heard him kind of explain, and I'm kind of convinced, and we're seeing it play out, is that the One Big Beautiful Bill is not some massive spending increase, right? It is just a continuation of the Trump tax cuts, and what we're actually seeing is just taxes rise even with that, right? So what I don't think the One Big Beautiful Bill has is the tariffs. And then the other thing that was kind of new to me that Mike Green has pointed out is that now that we're going to start to see the payback requirement for student loans, this is just going to be a massive revenue generator, tax increaser for the government sector, which means wealth being removed from the private sector, which means we're going to be even more reliant on credit growth. So these are all the things that are like stacking up against the macroeconomy. On top of that, we have the rate cuts today as well. And this is now, we'll head into the rate cuts and what this is going to do. And that, the first order effect is the rate cuts are just going to slow the interest income. Now, a 25 basis point rate cut is not the end of the world. I think we're already down one or two 25 basis point cuts from the peak. But we're just going to continue to chip away at that interest income, which is just a direct net add that has been there now for almost, 3 years now, that will slowly deteriorate away. And the immediate effect of that is going to be on the income side, right? So there's this immediate income effect. We've talked a ton about that in the past. But the other effect, and this is what we're going to get into a little bit more, is this idea of what it's going to do as rates start to push lower, what it's going to do to what we'll just kind of call the aggregate portfolio, or the allocation of all available assets out there, and how that's going to change. And again, I'll be piggybacking. And myself, I've always been moderately convinced by this idea of passive investing being a problematic issue from kind of like a game theory, agent-based modeling standpoint. But there's just some realities to portfolio construction in the way that the market works and what higher interest rates has meant for bonds over the last few years as it relates to, again, the aggregate market portfolio that will start to reverse course. And I just think that these rate cuts, the negative effects of the rate cuts are happening at the worst possible time. And that is something that I'll dive into in a little bit more detail. Before I do that, I want to go over at least, so we're going to look at this from two standpoints. The first is going to be this idea of kind of like the income government spending standpoint and what that means for the real business cycle. And then we'll look at this from kind of the financial sector as well. And what I want to do then is hit on two tweets that I posted earlier today before I went live. The first is this idea that rate cuts are happening, in my opinion, at the worst possible time and are likely going to pull forward some of the risks that have been brewing. They're just going to pull them forward in time. And the second one is this idea, too, that the dollar index right now better rally, and there are good reasons for it to rally right now. And if it doesn't rally, this is absolutely paramount key. Warren Mosler has been making this point. He's absolutely right here. If the rest of the world is done wanting to export to the U.S. because it's just not worth it for them for whatever reason, they don't want to deal with the Trump crap. They don't want to deal with having to see which way the winds are blowing for the U.S. If they are just realizing, you know what, we are good enough to consume our own stuff. We don't need dollars anymore. We're going to create new infrastructure institutions, financial institutions ourselves that can facilitate what we used to get with this agreement with the dollar. The U.S. is going to be in absolutely terrible shape in real terms. And this doesn't mean, I'm going to stay here for just a second, it doesn't mean that I'm against trying to increase manufacturing in the U.S. By no means do I think that the U.S. needs to be the net importer of the world. Now, I will say, just from a game theory standpoint, if the entire world wants to export their output, to me, game theory would dictate, if you are the lone importer, that is a win for you, right? So in other words, if everyone wants to work for you and all you have to do is print little digital pieces of paper and hand them off to their balance sheets, then that's a net win, right? And I just personally don't understand why we gave up, why the U.S. Electorate, the voter, didn't want that. But whatever, that's what's been voted in. That's what's been communicated. And if the dollar drops here in a scenario in which it should start rallying, given the rate cuts, given the trajectory of where we're headed over the next 6 months, it is likely a signal that the rest of the world has made up their mind, that they're no longer going to target the dollar relative to their currency to make it more beneficial for exporters to export to the U.S., right? Part of the reason that the dollar has had the strength that it's had over the last 20, 30 years, really following that kind of great financial crisis, kind of rebalancing of the world order, the world financial order, is because the rest of the world has wanted to export, right? It's seen its ability to grow its own manufacturing base as an opportunity to export to the U.S., and it was always this win-win situation where the U.S. would get cheap goods and the rest of the world would be able to grow its own manufacturing base and have some compensation in the U.S. dollar for that would then allow it to grow, more. If they're just done with that, the problem is the U.S. just doesn't have a manufacturing base, right? So in a sense, what the tariffs are doing is putting the cart before the horse, and we're just going to be in really bad shape because we don't have the manufacturing there to bring on board when the inevitable switch hits and there's just no more exporting to the U.S. Now, the counter to that, the very fair counter to that is, where else, what else is the rest of the world going to do? Where are they going to go? Are they going to deal with China? Are they going to deal with India? Are they going to deal with Europe? Where are they going to go to get the export relationship that they used to have and get all the benefits of that? Like, the U.S. is the only game in town. And it's a very strong argument. I mean, it still is a very strong argument. The U.S., for now, is still kind of the only big spender on the block. Up until a couple months ago, we also had the best kind of court system, the best legal system. You understood what a business deal meant in the U.S., and so there were a lot of benefits to kind of keep that relationship going. That's the big caveat. Again, I'll get into a little bit in a little while why I think the dollar should be happening, or should be pushing higher, given kind of where we're at. So let's do this. Let's go ahead and go back to the drawing board here, and I'm going to check out chat real quick. All right, I don't think there's any big questions in chat. So let's do this. I'm going to start with this supply shock, tariff-induced economic pause idea here on the right. I'll go ahead and highlight this. Whoops, don't want to fill it. My apologies. We'll go ahead and highlight this just so we kind of know where we're at. I like to get the notes on screen ahead of time so I don't forget anything while I'm talking. But what I want to do is I want to start out with this idea of just kind of what I think has played out over the last, say, 6 months since Liberation Day, or really kind of the precursor to Liberation Day when it was very clear what Trump was going to do. And then show in Deep Minsky kind of a simulation of, what were we expecting from this kind of tariff-induced supply shock, right? So I'm going to call this like an economic, timeout, an economic pause. And what would we expect? So from Deep Minsky, what I did is, and again, Deep Minsky is kind of our simulation tool where we can run various outcomes against what would have happened had you had a specific change in policy. And so what I've got on screen is just a really simple supply shock type scenario where all I did is I added a heaviside function where I essentially decreased capital utilization. In other words, all I'm assuming here with the tariffs is that output, we just had a brief pause here, right? That's essentially what I'm saying, is that due to the uncertainty of what the tariffs were going to do, we're going to just kind of pause our plans, pause the utilization of the capital that we have today, and wait to see what ends up playing out. So I'm not actually putting the tariffs themselves into play here, because I think they are moderately inconsequential to the immediate after fact in the outcomes that we've seen right out of the gate, right? And what I'm trying to establish out of the gate here is that what we've seen play out over the last 6 months is exactly what we would expect if we did have this kind of tariff-induced supply shock. So then we can also understand what we'll expect on the back end of this, right, as we head into 2026. Now, remember, this is just a simulation sandbox macro simulator. This isn't actually tracking with the quantitative data that exists we actually see. Again, it's just simulation tools. So when I induce this shock in 2029.25, so in the end of Q1 2029 on this simulation, don't equate this to today. I'm just saying that in this simulation, I'm inducing the shock just as the next business cycle is taking off. And I think that's essentially where it was, right? We were, in the next loop higher of real GDP is about when we hit the play button, if you will, on the supply shock. So we did the simple supply shock, and what do we see right out of the gate with regards to growth, with regards to employment, with regards to inflation? Well, on the simulation tool, we see a brief dip lower in growth, actually just a slight jump higher for like a day or two, and then growth immediately pushes lower with regards to real growth year over year, but then it will accelerate on the back end. But the first 6 months before we get back to kind of the trajectory that we would have been at is an immediate slowdown in growth. Inflation, again, that first 6 months is an immediate slowdown in inflation before it reaccelerates and then ultimately overtakes where we would have been otherwise. And then the unemployment rate is a brief pop in the unemployment rate before, again, it catches up on the other side of the cycle and pushes lower than it would have been had we never had the supply shock. Unfortunately, I don't have a rate of change of bank loans, but I can absolutely zoom in on just the level. And again, as you look into that first 6 months, you'll see the gap here. And again, the blue line is the supply shock simulation line. The gap in the blue line signifies that we did see bank loans spike higher once again when the supply shock hit immediately. And then the firm profits I'll explain in just a second. So let's go back to the drawing board here and kind of think through, what it is that we saw, right? We saw lower growth. we saw lower inflation and we saw lower hiring, which in turn is exactly what we ended up seeing play out following Liberation Day and really just Trump taking office. We saw this immediate hit to inflation pushing lower. We've seen obviously hiring take a big hit to a slowdown, and we've seen both GDP and real GDP remain relatively, nominal GDP went slightly lower, real GDP pushed slightly higher, in part just because we had such a big push to inflation. But either way, far from leaps and bounds ahead of what expectations were for growth either. So that is exactly, in the real economy, that's exactly what we saw play out, is consistent with what you would expect following a supply shock. What's also interesting is we also saw bank credit following that kind of start of the year supply shock also rip higher. And the reason this happens, and this is kind of counterintuitive, like why would there be a sudden rush to investment, right? Bank credit, loans. Why would there be such a rush when essentially we're all saying pause? And the reason for this is, and you see this in the simulation itself, is profits. Again, immediately it's kind of hard to see here, but that first kind of 6-month part, you actually see profits are really income because everyone's just pausing, dip ever so slightly. However, no one wants to lay off at this point in time. Remember, it's not a collapse. It's not an economic collapse at this point. We're all just hitting pause. That means we're not firing, but we're also not hiring. And since everyone's hitting pause, that slows that income channel down. We'll call it kind of the turnover of existing money just slows down a little bit when that shock hits. And that is what propels bank credit higher, because you still have all the cost. You still got to pay your employees. You still have to make sure the business doesn't collapse. And so everyone draws down on their credit lines. And that is what the cause is, at least in this simulation, of bank loans pushing ever so slightly higher. And again, we see this play out in the data that we're following as well. And so what we're seeing is consistent with what you would expect from this supply shock idea. Now, what the end game of this is that idea that I just talked about, that essentially we're getting this drawdown of credit lines. But what does that mean? Well, that means new income is now actually being flooded into the macroeconomy, and this is why supply shocks themselves have this bullwhip type effect. They have this immediate negative feedback loop that we just talked about that pushes growth lower, pushes inflation lower, pushes hiring lower, hits the pause on everything. But the offset of that, so the economy doesn't collapse in the simulation, is that bank credit fires higher, and it's that bank credit firing higher that's going to create the new income that will now actually flow back into the macroeconomy in reverse every single one of these three items, right? So they start off being kind of this negative drag on the economy, but they're all going to go from lower growth to rising growth, right? We're going to see rising income and profits because that's exactly what new credit is. We're going to see rising inflation. We're already starting to see a little bit of that. And I think very soon we're going to start to see hiring pick up, right? I know it's been slow, but now we're at that point where this can all start to reverse course. And over the next 6 months to a year, I expect the impact of the drawdown in the credit on the credit line, so the boost in bank credit that we've seen, to kind of carry this market forward as we continue down this kind of pipeline of government spending being flat, right? So we're not getting our growth from government spending. We're getting our growth from the fact that the credit cycle is accelerating. And the risk then down the line is the credit cycle in and of itself is kind of like a predator-prey model, right? Cost increase over time, and that becomes more detrimental, or it takes away from profit margins, and eventually the profit that was driving the investment function higher, so more credit, will eventually give way. And you see this, we've talked about this in recent videos, where really kind of the signal for that as inflation starts to push higher, that's when you know that the economy is getting so hot that it's likely going to find that crossover inflection point to where just the cost of doing business is eating into profits, and then that is going to lower investment, right? If you don't think profits are going to continue to push higher, you're not going to continue to invest to expand economic output, and therefore you get the credit cycle to collapse. And when that happens and government spending doesn't accelerate, that's when you get recessions to occur. It's happened every time we've ever found ourselves in that scenario. It will happen again if we find ourselves in that scenario once again. So that is the overall thinking on kind of the income side of things. And the way that the interest rate cuts are going to kind of tie into this is one of the main drivers of income has been over, or one of the, I guess to say kind of the marginal ad for income, maybe a better way to put it, has been that interest income, right? So the very first thing that is going to get hit, I can probably just pull this up real quick. Let's see, government, what do I usually type in to find the right one? Government interest. Is that it? Yeah. So, I mean, the big thing that has added, relative to the trajectory that it was on, before the rate hikes, we were at about 500 to 600 billion a year in terms of interest income out of the overall amount of outstanding U.S. debt, and now we're above $1 trillion. When that begins to slow, especially relative to the overall amount of money that's in the economy, that's going to take away that kind of last marginal dollar. And so that income begins to dissipate. And, now more than ever, that income with regards to where the macroeconomy is actually important to the overall macro makeup. And again, for this point, I'm just simply talking from the income channel perspective right now. On the plus side, I'm seeing people in chat talk about T-bill and chill. I love free money. Yeah, I mean, one of the arguments to be made right now is like this is the best opportunity, assuming Trump gets his way and only cuts rates and is able to force that through the Fed. It's as good of opportunity as we'll probably ever get to lock in rates this high with the capital that you already have. From the lending side, obviously the borrowing side has been rough, but from the lending side, about as good as it gets. And so going back to, there's, and I think this is probably just a good lesson, is there's two sides to every rate hike, right? There's a borrower and a lender. And so, yeah, with lower rates, the borrower is going to benefit here. And that might give a short-term boost to credit expansion, certainly housing will probably pick up throughout next spring and summer, right? It'll give a big boost to housing, and that's fine. But I don't think that whatever boost we're going to get in the short run will offset, more than 6 months to a year, the negative downside, assuming these cuts keep coming, right? I mean, if Stephen Miron gets his way and we're below 3 by the end of this year, and I just say that as, assuming Trump gets his way, I mean, that's a huge cut in interest income, and that will only increase the risk of a, larger slowdown that would then follow, right? I just don't think, and I think we went through this during the last stream, I just don't think that the amount of cuts that you would get would ultimately generate enough additional income from credit to offset the cuts, maybe for a very short amount of time, but nothing terribly. It's not going to be monumental. So there's that aspect of it, and that's something that we've gone over many, many times in the past. The next part is then from the market side, and we're just going to call this kind of the portfolio side, and really what this means. And this will also tie back in to why we kind of need a stronger dollar to start showing up here very, very soon. And the idea here is that, let's just talk about what rates mean for the market portfolio, and not just put on your, I want to make as much money as I can, highest return as I can, with the least amount of risk as I can sort of hat, right? And that is, you could think of the market as a whole as trying to achieve that end, even if not every agent is trying to achieve that end. That is what the market as a whole is trying to achieve. And so one of the things that happens when you increase interest rates is if you need a specific risk target with your overall portfolio of assets that you want to include in that basket. So in this little diagram that I have here, whoops, I accidentally clicked those. Sorry about that. Giving Larry Summers some love inadvertently. If you think of the green box here on screen as, I'm gonna clean this screen up real quick. If you think of this green box here on screen is the total amount of dollars that are available, right? So over time, it grows, it grows, it grows. Occasionally, it shrinks. When deficits get surplus or we get a credit crisis, but over time it grows, and as it grows, the overall amount of valuation of stocks grows or bonds grows to fill in that total amount of dollars available, and so you have to allocate these dollars as the market portfolio. One of the things that happens when you raise interest rates is what that allows it to do is the overall value of bonds takes up less space on the overall balance sheet, but the yield that you're getting, right? So the actual, what they're paying on those bonds increases. And so what this allows you to do is take on riskier and riskier assets within the portfolio of the kind of market, the market portfolio. And so you get the double effect, right? You get the additional interest income of the treasuries that are flooding just the macroeconomy that boosts stock prices as well when you raise interest rates, but you also allow the market to start taking on more risk. So you could also think too, within even this stock portfolio itself, that this could break down into two categories, right? You could get what was called risky assets and safe assets, right? And so, or safe stocks and risky, right? So we'll call these risky, we'll call these safe. And what ends up happening on the flip side, when you start reducing interest rates, is you actually end up increasing the scarcity of bonds, right? And what I mean by that is the price of the bonds themselves starts to increase. So what I'll do is I'll try and drag and drop or get these to group so this all move together. So as bonds increase, and what I have here too with the pink box is essentially just everything else, right? As bonds increase, everything else kind of gets shoved out of the way, right? And so you get this scarcity of bonds. And we know they're scarce because their price is just, it's going up, right? That is the reason that we know that they're scarce. And what ends up happening too is you then end up needing the safest of stocks, because there is this shortage. You end up needing the safest of stocks to fill in the gap, right? And that's why we end up seeing just one part of, let's see if I can do this without messing this up too much. Yeah, anyway, what you end up seeing is, yes, stocks get squeezed out, but really what gets squeezed out is the riskiest of the stocks, right? And this is going to be your like things like emerging markets, rest of the world, your value stocks, the Russell's done terrible, right? All those aspects get squeezed out, and you end up getting what are just going to be called bond replacements. Riddick Goyle has his video online where he discusses this theory. You just get your bond replacements that end up filling in the void, right? And that's where you get the Magnificent Seven or FANG or whatever, right? Your Facebooks, Metas, Googles, Apple, Nvidia. Those stocks become kind of these bond replacements when interest rate starts to fall, and so you get this shortage, scarcity of bonds themselves, and then everything else that's even riskier, that has more volatility, ends up taking a hit as well. Now, in and of itself, assuming income and flows kind of continues at the current pace is fine. We could just, reverse course back to the 2010s. But the current predicament that we're in is this reality of, and why it's concerning if rates really start to fall, is what the bond income has meant to the private sector. And this is, again, Mike Green's work here is I think applicable now more than ever. And that is that what the higher interest has done is it has allowed retirees who are growing in number by the day, the baby boomers are all retiring, it's allowed them to hold on to their very highly valued stock portfolio, right? I mean, most highly valued relative to PE ratio, I think, in history at this point, right? Because they haven't had to sell any of this because the interest income they're earning from bonds has been supportive to the lifestyle they wanted. Now, I'm not saying that they're living their entire lifestyle on interest income, and I'm sure some have to sell some of this portfolio that they have, but they've been able to just, live on far more than they would have the higher interest income. But as the interest income now goes away, you're going to have to see some of that selling take place. And that selling will likely take place, start to really pick up at the most inopportune time possible. And that's going to be mid-2026, right as the natural progression of this business cycle is going to come to an end, right? And so you're going to be selling when the income, the green box is actually starting to shrink, right? So there's no one to buy those stocks. There's a shortage of bonds that will only push bond prices higher. Rates will have to come lower, likely. The function that will play out is the Fed will cut rates as they start seeing the inevitable slowdown of the macroeconomy. And so you'll get this reinforcing cycle of kind of a reversion to the historical mean of where stock assets should be. And again, tying this into Mike Green's concept is that we've had a passive investing phenomenon play out for almost a half a century now, maybe, 30, 40 years. And that entire, everyone's just bought and held just from the flows. Well, when those flows reverse course and there's not enough buying to offset that, you'll get a market correction that will finally take place. And then there's just no coming back at that point. There's no way to reinflate the bubble because the mechanism that made it so enticing in the first place just gets broke, right? And that is the real risk. Now, I want to be very, very clear. I'm not saying this has to happen. If the tariffs get overturned in the Supreme Court in November, that is going to be a game changer, and we'll have to just adjust and see where we're at that point. I don't know where we will land. We just have to see what the president does, what Congress does, right? I mean, there are other paths to get tariffs reinstated, and we'll have to see what the Supreme Court does and what the decision will be, and if there will be a refund, and like what that will all look like. We just don't know what that looks like. But if it is a refund that has to play out and these just become illegal, then to me that's a massive game changer, and likely very much softens the blow and likely gets us through another cycle where the whole passive investing reinforcing flows just supports the market for another 4 or 5 years in the future. But if it goes the other way, I'm thoroughly convinced that the credit cycle will end sometime, peak. When I say peak, I mean, when I say peak, like the market, the last credit cycle in the great financial crisis peaked in 2006, 2006, early 2007. Crap didn't hit the fan for another year, right? So I'm not saying if the cycle peaks in 2026, that necessarily means by the end of 2026, the S&P is sitting at zero. What I mean is the cycle peaks, and then from that point we begin to assess, okay, where's the fragility? Where is the biggest risk? How long does it take for this thing to manifest itself? And at that point, then we can look at, when might the big crash happen? Could it be as early as the end of 2026? Yes. Likely the worst of it happens. The version of October 2008 probably happens in 2007 or 2027, if the worst case scenario ends up playing out. And the thing too is, and I mean, it's worth pointing out that if the interest income's not coming from the bonds, now granted the bonds themselves will just increase in value, but you'll have to start to sell those, and then you'll also have to start to sell the stock portfolio to meet the income need of the lack of the income coming in from either the credit cycle or the fiscal side of things. How does this tie back in to the dollar? Actually, let me jump into chat real quick, and then I'll turn. Go back. Okay, so I got a couple questions. What about the weighted average coupon? Frank, can you extrapolate a little bit more? I'm not entirely sure I'm tracking there. Let's see. I was about to say Mike Green portfolio research is kind of contrary to the idea that markets are trying to maximize return. Yeah, they're more so a feedback mechanism. Yeah. I'm probably not thoroughly explaining Mike's point. All right. So how does this feed back into the dollar, and why, going back to the tweet I had, do I think that the dollar is more important now than ever after this sip of coffee here? While I sip this coffee, hit that like button for me. It would be much appreciated. Okay. Back at it with the stronger dollar. So one of the things that's going to end up happening is as safe assets become scarce, right? And you just have to realize how important safe assets are to portfolio construction at the macro level. Like if you're not an asset allocator, it took this for myself a while to really have this fully set in. But safe assets are what the kind of rest of the leverage speculative side is going to build from, and you need a certain yield from those safe assets before it's like a buffer, essentially, before you can start to add in the riskier assets within that entire portfolio makeup. And so the yield needs to be there, and there's such a need to get those safe assets into portfolio construction that what ends up happening, and this ties into the dollar, what ends up happening is it actually drags the value of the dollar higher. Right. So as there's a scarcity, so the bonds become more expensive. That's all I mean by scarcity, is there's a scarcity of these bonds, right? We know they're scarce because they're more expensive. The thing to get those also gets dragged along up, right? That the dollars themselves become more valuable, so you can get the thing that you need in your portfolio that is of value, right? So What happens is that as rates get cut, the dollar should push higher. Now there's both a portfolio reason for this and an income reason for this, right? Lower rates just mean lower income, right? There's a reason that higher interest rates are so associated with inflationary countries. Now they have their own reasons for that, like borrowing in other currencies, but there's a reason we haven't been able to get below on inflation 2% target, and why we are trending back higher is because you're just setting the price of money higher, right? You're creating more money, you're setting the price of money higher, you're pricing everything in the economy higher, and you're creating the income to support that. That is what higher rates do. And so that means the value of the dollar pushes lower because of that, right? Or the whatever underlying currency is in that interest rate, right? And so from an income perspective, that's going to reverse course, right? But then from a portfolio perspective, you're also going to get that to change, because now you're creating scarcity of the safest thing that's in there, and that drives up the next safest asset, the value of cash, as well. And so that's why during ZIRP, we never really saw the dollar take any massive plunges the way that we've seen since Trump took office. And so bringing this back, this is why we're at such a crucial point here, and why the dollar really better start rallying, right? I mean, today better be the day that we look back at and say, oh, wow, we really are headed, or we really dodged, the worst of it, because if the dollar ultimately collapses further from here, what that indicates, and I have the DXY pointed up. I saw Mosler today posted the won versus the U.S. dollar, and that it just kind of continues to collapse there as well, the dollar relative to the won. is that if the dollar continues to collapse here, what that is saying is there's not a rush to get dollars, to get treasuries as safe assets, meaning the rest of the world, they've just given up on that game, right? The reason there's that portfolio effect in the first place is because the whole market portfolio wants those dollars, right? And that includes the entire world. Well, if the world no longer wants those dollars, and that there's also this other element of it where the rest of the world is suppressing their currency relative to the dollar, they're done doing that, then we should expect the dollar to collapse. And so then in real terms, we're going to continue to see a collapse then of the dollar, meaning the real impact of that, so the inflationary impact of that ends up being amplified, right? And then going back to one of the things we talked about at the outset with government spending is it's always relative to inflation. It's always needs to be, real income with regards to the real economy always needs to be adjusted for inflation or the real element of that, because if you just have less income in terms of what you need to buy with it, that in and of itself can start the spiral lower. So that is why, if we're set up here for the dollar rally, if it doesn't end up following through, I think we could be in for a bit of kind of double whammy hurt as we head into the end of this cycle come 2026. Maybe a better way to put it is it will just fast forward the deteriorating effects of government spending. So I'm going to go back to this and just say, I want to be very, very clear so I'm not misheard. I'm not saying this has to play out this way. I'm not saying that we are necessarily down this path, like the worst case path, going forward into 2026, 2027. But relative to where we were 6 to 9 months ago, it is now a possibility, right? It is absolutely a possibility. And we could be in a bad enough income spot to where this entire thing finally just rolls over and blows up, right? The whole portfolio construction, dollar dominated world just completely reverses course. And that is going to be really bad. I mean, there's no other way to put it. Like in real terms, it's going to just suck. I mean, like I can only imagine if the worst of it plays out and the rest of the world is just done exporting to the U.S., the normal, or I should say that the median U.S. Household wife is going to be ticked to high heaven when there's the new appliances and stuff are not going to be getting delivered, or the grocery store shelves are, when inflation finally hits, essentially is what I'm trying to say. Not going to be too many happy campers when that finally plays out. But again, I guess, we voted for it, so you can't complain too much when it's what you wanted. All right. I think that kind of covers the majority of it. I see I had quite a few questions come in. Unfortunately, I'm not seeing the highlighting work anymore of question, but I do see the people question right out of the gate. So we will jump to that. What about the weighted average coupon? And then Frank, I see, okay, wouldn't the passive rebalancing add a bit to equities? According to Mike, the opposite was true relating to the 2022 equity sell-off. Wouldn't the passive rebalancing add a bid to equities? Frank, I think, if I'm tracking correctly, I do think the immediacy here is like over the next 6 months to a year is that, we will see like the immediate impact will be a continued push higher in equities here. I think that's what you're asking. And I remain bullish equities myself. In the longer term trajectory, we might see some volatility here because of kind of the post-Fed day, and then just the fact that it's OPEX and whatnot. But I'm not saying this starts today. I hope that answers your question. Next question: could an increase in margin lending against financial assets reduce the need for retirees to off their holdings? Yeah. I mean, we are seeing margin continue to push on higher, and yeah, I mean, I do think I do think we see that exact same thing play out, right? Where we will get margin lending, we will get leveraging heading into the end of the cycle, and that's why I don't think this thing peaks until 2026. And that we don't see effects of this until the end of 2026, 2027, assuming kind of the worst case scenario plays off. The best case scenario is tariffs become illegal, interest income just continues to float in, Trump doesn't get his way on tariffs or on the interest rates, and we just go back to the way it was, deficits continue to accelerate. And if that does, we still will get an end to the credit cycle, but it will be like a 2015, 2016 type event, maybe even a little bit of like a 2018 type event. It won't be a 2007, 2008 event or a 2000 type event, right? That is, that's the difference here, is that we will, have a soft landing. I don't know if most retiring accounts. Yeah, so we're not going to see a leveraging up from the retirees themselves, but the overall, market portfolio itself can leverage higher. What you just explained about higher rates pushing the dollar down, this is fundamentally a supply and demand argument, right? It's just that most people don't understand how rates impact the dollar. Yeah, exactly. I mean, I think, God, I can't even think of the traditional argument for why higher rates. Was it because the rate arbitrage is why they think the dollar will end up pushing higher in a higher rate scenario? How about gold, Hassan? I think, gold's been doing really well. Yeah, and actually, that's really good. That's a really good question with regards to gold, and something I've been thinking about a lot. I think, probably if it's worst case scenario, and by worst case scenario, I mean fiscal stops and the world stops exporting to the U.S., then I think the gold in dollar terms just continues to push higher. And we've seen half the move or something like that, right? Still, I mean, we're still in part of the business cycle that just generally gold does well. This is what's so hard. This is what's so hard about where we're at. Everything we've seen so far is just kind of what you expect in this part of the business cycle to begin with. Growth, inflation kind of starting up at the exact same time. We're just in that quadrant where the assets that have been performing well, you'd expect to perform well. But if it is a worst case scenario type play here, then I would consider gold to continue to push higher. And I think that's part of the reason why we've seen gold push so high to begin with, is because it's central banks buying, right? I mean, I think it's such it could be such a tell right now as to what central banks are planning to do relative to the dollar, right? They're just done with the game. They're done with the whole suppressing their currency relative to the dollar to help with exports, right? They're biding their time to set up whatever it is, the next thing is going to end up being. For me, it's more of like an interesting tell than it is necessarily an investment opportunity. I used to always say, for the rest of the world, I've always said, it makes sense to own some physical gold. Just because there's been so much stability in the U.S. and the U.S. dollar, at least domestically for American citizens, just has never had to face the sort of risks that the rest of the world has. And yet here we are, where, it's 9 months ago, it seemed impossible that we could be having this discussion, but it really is, right? That possible for the U.S. So, gold is obviously had a heck of a run up, way overbought. I'm not saying go buy today. I'm not going to pull a Jim Cramer here and see an asset that's flown higher for the last couple months and say, go buy it. It's very overbought. But in the sense of, if you're already holding it, I wouldn't say this is necessarily an all-time high has to be in at this point. We could still very much see a continued push higher for a lot of the reasons we've already talked about, and I think those have been the fundamental drivers that we've been seeing pushing gold higher. Good question. If dollar starts rising, gold fall. Yeah, I mean, I do think if we get that real big dollar rally and gold does fall, that's a great tell as to why. It doesn't actually necessarily have to fall. I mean, you very much will see them rise in concert, especially as we get closer to kind of the end of the business cycle. Now, when the end of the business cycle hits, that's usually when there's the rush to the dollar out of assets like gold, right? So gold in this instance is, it's sitting in right here. And there's a rush out of these assets to get the dollars that are shrinking to buy the even safer of assets. Again, it's hard to know. I wish I had a better answer here. That kind of when crap finally hits the fan and we go to that inflection point, like will that actually play out this time? And that's just what we don't. That's what we don't know. I mean, I will say, if my advice would be, if you see a collapse in like growth in markets, and you see things like the dollar not spike the way that they would have, and you see gold continue to push higher in an environment like that, and you're domestically in the U.S., that is a sign that you go get a second job or something like that, because the reality is you're about to live a much tougher life than you did, prior to this administration starting and this desire to stop the import cycle that we've had. And I do want to touch on that again. Let me hang out here for just a second. I want to make it very clear that I'm not making the argument that like we should continue just out of obligation or anything, like the import cycle. That's not my argument, right? Like we can increase the manufacturing base, and we should. You just can't do that by tariffs, right? Like investment requires income, and income creation creates the investment, and it's a virtuous upward cycle, right? You have to have more money created to create the profits to induce the investment in the first place. I mean, just think about it from a just direct, like just if you knew tomorrow that there was going to be less money out there, would you start a new business, right? I mean, if there are 300 million Americans or whatever we're at, 200 and some odd million Americans in the workforce, and you just knew that every single one of them tomorrow was going to get a pay cut by 10%, would you be like, oh, wow, yeah, I really want to go start a car wash business? No, right? I mean, you're not, because you had this omniscient ability to know that everyone was going to get a pay cut tomorrow. Well, that's what the tariffs are. They're just a pay cut for the macro economy. And how that shows back, I mean, the signal that comes back to the private sector is, or really the firm sector, is just lower income, lower revenue, lower profits. And that's why it's profits that drive more investment, right? So, and on the reverse, if you knew tomorrow every worker in America was going to get a 10% raise, right? Well, yeah, maybe I will start the car wash business because I know the rest of the world has the money. So I am absolutely like, let's create more car washes, let's create more output, let's create more car manufacturing, let's do all this. But the way you do that is to induce investment. You can do that just directly, government spending, or you can create, tax incentives for companies to do that, right? I mean, there are a million ways to do that, but it all boils down to you need that initial boost of investment to get the cycle up and running. And we've done the opposite, right? I mean, we're doing the opposite, and we are never going to get what we want. All right, I'm seeing some back and forth about George Robertson and Riddick Goyle. Yeah, if you type both those into YouTube, you will find the videos that I was talking about. And then there was a video called like "The Fed Doesn't Matter" or something. I think it's still up. I guess I could check real quick if it still is something that exists. Give me one. Yeah, here it is. These two right here. where inflation comes from, and the Fed does not exist. They're a little old at this point, but they still they're still well worth a listen. And then I think Riddick and George had a channel together as well. But yeah, these two videos are definitely worth a watch. I guess I can zoom in just a little bit here. All right, what up? What else is up? Okay, yeah, it's still up. All right. I think those were kind of the main points that I wanted to hit on tonight with regards to the Fed announcement. We've been going for an hour now. Before I let you go, hit that like button. It'd be much appreciated. And then, as always, head on over to appliedmmt.com if you're an active trader, an active investor, for my research and analysis. And then, as always, all this stuff is for research and education purposes only. I'm certainly not making any buy or sell recommendations over there. I've also gotten myself back to publishing articles as well. So we have articles as well as my weekly video updates. Vladimir, what's up, man? I think you might be joining right at the end here of the stream, but yeah, those were the highlights of what I wanted to hit in kind of this emergency Fed post FOMC discussion, and where I think things are headed, and how this whole rate cut thing could turn out to be far worse than better in the long run. And again, you can rewatch every kind of reason why, once again, to tie this all back together. And I'll finish here. I'll reiterate here as I sign off, and just say that I'm not, at this point, I'm not saying this has to happen. There are so many qualifiers, so many things that are contingent on the next couple months here of policy decisions that matter, but we really are at that inflection point, and I think I would be remiss if I didn't, as one of the first people to get on the bull run at the end of 2022. I'd be really remiss as kind of the perma bull to not lay out, hey, we could very quickly find ourselves in a less than stellar spot. In not too short a time either, right? I'm not thinking end of the decade, right? I mean, I'm thinking within a year or two we could find ourselves there very, very quickly. And hopefully, too, I've laid out, how if you're watching at home and you're not a pro subscriber to Applied MMT and not getting this every week, at least kind of from a distance, how you could be tracking the potential implications and the various moves that we need to be seeing. So the big takeaway, we really, really need to see the dollar take off. If a strong dollar can really withhold here as we're seeing this big policy shift happen, then I think that, it gives a little bit of a cushion to kind of the most dire of outcomes. And that'll be one of the things that we watch out for. And then two, just how does the rest of the business cycle play out? And again, so far it's kind of been on track. So yeah, I think that's kind of what I've had for tonight. I'm not seeing any other questions pop in. Yeah, Vladimir, I like that. Inflation ceiling has been lowered. Yes. Yeah, we will, at least lowered. Still probably see inflation kind of take off here, probably even jump to the upside of where rates are at. But it is really interesting to see this demand for rate cuts happen right now. As we see like the Atlanta Fed now GDP casket to 4% or whatever it is, but whatever, those are the wild times we live in. Yeah, Django Geek, exactly. Exciting times. All right, everyone. Thanks for tuning in. As always, again, hit that like button on the way out. It is always much appreciated. But that is what I have for tonight. We'll see you at the next stream. As always, good trading and keep following those flows.